Hello and welcome to a new edition of CryptoKoryo podcast. Today I'm very happy to have Bob with me from Maverick Protocol. Hey Bob, how are you doing today?
Hey, great. Yeah, thanks for having me.
Great, great. Thanks. It's great to have you here today with us. So today we're going to talk about Maverick and your new implementation with V2 of the solution. We're going to talk about the DEXs and the space, around AMMs and the different variation of AMMs. But before going deeper into that subject, let's start with you. Can you give us a short introduction about yourself and your background now, how you came to DeFi and building in DeFi?
Sure. Yeah, so I'm actually a former academic. I was teaching signal processing and information theory at Georgia Tech for a number of years. And then I got into the startup world and started a cybersecurity Web 2 company, ran that for a few years, and jumped to full-time crypto in 2021 with Maverick. So my background is a lot of math and optimization, these sorts of things. So I saw a big opportunity in being able to give folks in DEXs, LPs and DEXs much more flexibility in how they approach LP.
Yeah, perfect. I think AMMs and DEXs is probably one of the sectors in DeFi where we have the most of, the math and, the scientific side maybe going on with all these optimizations on pools and AMMs and, how to improve capital efficiency and also information theory. So that's very interesting that you found this, intersection of your
Mhm.
kind of skills within crypto. Let's start with a kind of overview of AMMs. You mentioned about, you know, there has been a number of variations over the years about how to have the best kind of AMM model, starting from Uniswap V1 or Bancor V2, and then later Uniswap V3, which was kind of probably the biggest innovation in the last years with concentrated liquidity. That was around 2 years ago already. Can you tell us about what has been happening in the space after that? I mean, I know that there are a lot of people who have worked on different variations of concentrated liquidity, trying to improve it. But can you walk us through the latest innovations in the space, in the DEX space?
Sure. Well, I think Curve gets a lot of credit as well. So Michael really came up with the first concentrated liquidity model with stable swap. It was not as versatile as Uniswap's range AMM, but it was pretty neat. He made the observation that in an XY equals K sort of curve, you spread out your liquidity from price equals 0 to infinity. And of course, if you're swapping stables, that doesn't make any sense. You can concentrate your liquidity around price equals 1. And so yeah, that preceded Uni V3, and the V3 folks really generalized that and did great work with the range AMM. So the range AMM lets you stake liquidity in any price range, and across that range, you've staked your liquidity evenly. I think there's folks trying to do order books, especially on things like Solana, where you've got faster block times. Ultimately, if you're a market maker and you're setting your own prices, arbitrarily, that's kind of the most flexible thing. That's not really tractable on EVM chains. You have to, as an LP, you have to be able to set kind of a programmatic price essentially. So automated market maker is that's what it's doing under the hood. The AMM pricing algorithm is setting the price that you as a market maker will take. And so UniV3 had this interesting innovation where market makers, LPs, can set the price from A to B in concentrated liquidity. And what that lets an LP do is get higher capital efficiency, which means they're getting more volume for a given amount of capital that they've staked. And their return is proportional to the volume because they're getting fee times volume. That's the fee they receive. So that's really great. The problem with that is as the price moves outside of your range, you go from high capital efficiency to zero capital efficiency. And so, there was a generation of kind of vaults. So Arrakis and others said, well, how about we solve that kind of going out of range problem by creating a vault where we essentially manually offline, off chain, rebalance, reposition the liquidity. Curve V2 also had kind of an idea like this, where the stable swap curve could be kind of shifted based on their A and gamma parameters. That never really took off. It's not really flexible enough to shift liquidity. But so I'd say to answer your question, I think the latest innovations are around how do we stay in range? How do we give LPs more flexibility? How do we let them be more profitable? And then with Mav V2 and Uni V4, there's this idea of programmable pools, or in Uni V4 they call them hooks, where you can let LPs or designers, programmers implement their own custom logic into pools. So I think that's the most recent sort of innovations is more flexibility. And Mav V1 does those sorts of things. I can get into that if we want to go there. But yeah, I'd say that's the landscape.
Very interesting. Something that you mentioned that caught my attention is comparing Solana versus EVMs. And you mentioned that Solana is more suited for order book models versus EVMs that are more suited for like AMM models work best on EVMs. Is that correct? Because of the block size and the speed of Solana. Is that correct?
I think so. There's order books on all the chains. I think it's just you have to have pretty short block times for it to work well, and so Solana has that. And so you see that a bit in Solana. But the problem with that is in order books, you can't be a passive LP. That's only going to be the domain of professionals who can move around their orders, at lightning speed in reaction to markets. What an AMM tries to do is essentially democratize this market making, so that you can have a market for a token, and you can have it with very little complexity on the capital provider side.
One interesting observation I had is we had actually at some point Banker on our podcast, and Banker was actually one of the first AMMs. They started
Mm-hmm.
way early, and recently they actually, since 1 year almost, they've pivoted to Carbon, which is this order book model, although they are on Ethereum mainly. Do you see a trend where, I mean, there are some limitations on with AMMs and the ways, the imbalances that you can have in pools that can affect actually the profitability of liquidity providers. Um, do you think that this is a model that could gain more traction over time, this order book model, independently of the chain?
I think it's tricky. It depends on the token that's being traded. So for blue chips, you can have an order book, and that could be pretty successful. I think there's a whole domain of AMMs where you're trying to provide a market for a very thinly traded token. So one interesting thing that I've that's come around is like with the Farcaster community. I think WAGMI Fair Launch is pretty neat. You're seeing a bunch of meme coins on base, and if you launch a meme coin, you need a market for it, and you're not going to get a market for it in order book. It's hard to set the price. So this kind of really wide AMM ranges or distributions can be great for that. So I think it depends on the use case. There are use cases, blue chips, where order book um, models can make sense, and the trading is really deep. But then there's a whole kind of section of crypto where that doesn't make much sense.
Now, before going to the details of Maverick and the new version, I had two more kind of business-related questions about DEXs based on my own observations as a narrative trader and analyzing trends. One is that, I mean, back, like if you look in 2020, 2021, um, if you were a liquidity provider or if you had like money, if you were a whale, your opportunities to have some kind of passive income or some kind of stable conservative returns were limited to providing liquidity on AMMs or maybe some lending and borrowing, protocols like Aave, etc. However, I think that this has changed, especially this year with with LRT protocols and especially the arrival of all these point meta. Where all these new protocols that are providing points and from different sectors, from gaming to derivatives and all these things, and this has kind of spread the concentration um, of getting some kind of returns. um, what kind of trends do you see? Because I'm saying that because I think that it's harder maybe to attract liquidity compared to before for people with money, where options were limited to dexes. Are you seeing this in reality in terms of TVL and other metrics related to dex sector?
Mm-hmm. Yeah, I think that's a good observation. So the LRT thing is you're staking to kind of secure other operations. So that's a really neat kind of useful mechanism for capital. I think points is mostly pre-TGE, so that given token may not have any capital yet. Although you see it where there's a stable coin, and eventually there'll be a governance token, or an LRT, and eventually there'll be a governance token. And in those cases, I think you are seeing places where points get credited to DEX LPs for the kind of utility token, and then there's the governance token. So a staking token, for instance. But I think that's right. There's certainly more opportunities in Web3 for places to put your capital, and AMMs are not the only stop in town anymore.
Great. Last question is regarding the tokens of DEX and DEXs. Most of the protocols, most of the DEXs have their own native token, and usually this token is used to kind of to provide additional rewards for liquidity providers. And it seems that because most of these tokens they have inflation, the holders of these tokens are kind of subsidizing the LP activity, which as people get more awareness of this, it seems that because of this whole thing, and the DEX related tokens haven't been really performing really well, although some of the DEXs have very high volume, trading volume, liquidity providers are doing well. Do you see a shift in the mentality and this model of using a kind of inflated token that is just going to LPs and nothing to token holders? Uniswap, came up with this fee mechanism solution. Others are trying to innovate. What kind of trend do you see there, and what kind of solution is like? Shall we share revenue to also token holders? What are your thoughts there?
Yeah, I think so Uni has teased people with the fee switch for a long time, and it seems like that's just never going to pass. That's the decision that they've collectively made, which is it's fine. I think if you want an asset to have value, it needs to have some sort of new money in, and that new money in is either fee revenue going to the token holders or something going to the token holders, right? Yeah, I think a fee switch is an option. I think Curve actually did great work there early on. They were kind of the first model where they had this token Flywheel, and there is some fee that goes back to the token holders. I think the challenge with Curve is they kind of infinitely emit to LPs. So the early VE Curve holders basically just guaranteed themselves sort of infinite emissions no matter what was happening in the protocol. One of the things that is part of Maverick V2 is a better token flywheel where the emissions stop unless there's new money in. So it's all about kind of new money in. That dictates how much more emissions can happen and who they get, who gets those emissions. So I think there's still plenty of room to innovate there. The protocol fee switch it's a really interesting thing because so Maverick has a protocol fee switch as well. One of the challenges with flipping the switch is that if and when somebody forks your AMM, they can fork it, provide the same functionality, but without that fee overhead. And the fee overhead's ultimately coming from LPs. You're siphoning off a bit of their fees and redistributing it to somebody else, to token holders, for instance. And maybe those two parties are the same, and you can kind of incentivize those to be the same. You can give LP boosts based on VE and these sorts of things, or based on token holdings. So there's certainly a tricky balancing act, and I think we're still kind of finding our way collectively as a DEX world as to what kind of token model makes sense.
Interesting. We're gonna cover more about this tokenomic aspect and the flywheel you mentioned when we will talk about the V2. But now let's start. Let's go deeper about Maverick. One of the things we can see on your website is Maverick is the AMM for all market conditions. Can you elaborate on what does that mean and how is that special? All market conditions.
Sure. So if we go back to just a fundamental explanation of what is new about the Maverick AMM in V1. And the Maverick V2 AMM is similar. It's more gas efficient. It's got more degrees of freedom, but some of the core ideas are similar. So we think about, you've got XYK sorts of AMMs that spread the price from 0 to infinity. You've got stable swap AMMs that kind of concentrate the liquidity around a given price. You've got range AMMs like Uni V3 and their forks, where the liquidity is in a range. We think about Maverick AMM as a dynamic distribution AMM. So there's two new things there. I'm going to start with the last one first, which is the distribution AMM. Instead of just having your liquidity as an LP spread out over a price range, you can have it distributed in any distribution over a given range. So you can have a bell-shaped distribution, a multimodal distribution. There was this paper out of Harvard that said the kind of right distribution of liquidity for an AMM, if you want to weigh risk and reward, is actually this exponential shape. It's kind of bell curve-ish shape. So in Maverick's AMM, you have this flexibility to put the distribution any way you want. The second component is the dynamic component. And so I mentioned this problem of being an LP and going out of range. And as soon as you're out of range, you start printing fees. In the Uni V3 world, there's all kinds of professional LPs that use offline mechanisms, off-chain mechanisms to reposition the liquidity fall price. So that's really gassy. That only makes sense if you have a ton of capital. In Maverick, the AMM lets you automatically move your liquidity with price without you having to intervene as an LP. So we think about it as kind of democratizing what sophisticated LPs can do by letting the distribution move on chain. And so back to your question, what does that mean in terms of market conditions? Well, an AMM, the range AMMs or stable swaps, all these sorts of AMMs, you're really making a bet that the price will go sideways. If the price does not go sideways, you will have impermanent loss. And that can be okay as long as you have enough fee to kind of cover the impermanent loss. The impermanent loss is basically you as an LP provider and most AMMs are agnostic to which token you hold. So if it's ETH USD pool and ETH goes up, you're going to hold a lot more USD and a lot less ETH, which is not ideal. And you're hoping basically that you'll collect enough fees from the volatility as the price goes up that it'll make up for any price appreciation. And this could be a great bet sometimes and a terrible bet other times. In Maverick, you have the flexibility to have your liquidity move with price, so you can make a more directional bet. It's not just a sideways price bet. You can make a directional bet up or a directional bet down in price. And so that's an example of the sorts of knobs that Maverick has that the other dexes don't.
That's very interesting. So, can you elaborate on, like, let's say that you mentioned ETH-USDC pool, and let's say that we, like, somehow the market, like, the LP has a bearish overview of the market and think that ETH will go down. What does that mean in terms of how can the LP express that view with Maverick? Will that be a larger allocation to the USDC, or how does it work exactly?
So the way to express that belief is to LP. So if we think about ETH being on the right and USD being on the left, you would LP a mode left position in the AMM. And what this will do is it'll let the distribution of liquidity for the LP will follow the price left, follow the ETH price down as it moves. And so what that enables is the LP is able to stay concentrated and stay near price as the price moves down. And so that will the idea is that the LP may be exposed to more fees.
And then another question you mentioned about, so basically when Uniswap v3 came, people realized that there is a lot of overhead with managing these positions, LP positions, because they all of a sudden, they're out of range, and these things need to be rebalanced all the time. So then third-party solutions came, like Arrakis you mentioned, and other protocols who started to build on top of Uniswap v3 to kind of automate that part. And now, so Maverick, but as you mentioned, they are kind of not gas efficient, and then you're paying a lot of gas every time you're doing something. You're paying some gas fees, which is not optimal. So is Maverick's solution like entirely on-chain first? And second, is it fully like kind of hands-off for LPs? They don't have to do anything other once they provide the liquidity, and they pick the tiers, the fee tier, and then the mode you mentioned, left, right, etc. Is it hands-off, and then they are always kind of ensured to provide fees no matter the price to get fees?
That's exactly right. Yeah,
Okay.
yeah. So the kind of vault solutions, they're not truly automated. Somebody's calling some on-chain call to reposition liquidity, and maybe that's programmatic, but it's not on-chain. You could use keeper bots to do that, but it's not really on-chain. So the AMM itself is able to move liquidity around based on price. So part of the design was making it so that you could scalably move a whole bunch of LPs in a given distribution, really gas efficiently. And we've got this kind of linked list thing that lets you do that. And so on swap, if some LP needs to move, the swapper actually pays the gas, but the gas is on the order of 15, 20,000 gas. So it's the swapper barely notices, and you're able to move hundreds of LPs that may be in kind of different positions, but all want to go left at once in kind of a scalable way. You don't have to make 100 calls like you might in some of these other vault solutions. So yeah, that's basically how it works. It's a core to the AMM, and there's no, you said it right, there's nobody calling keeper bots to move around the liquidity.
So from what I've seen from the data, it seems that Maverick is mostly being used by aggregators compared to traders going on the interface and using it. Why is that? What is the reason for that?
I think there's actually there's like thousands and thousands, tens of thousands of swaps a day through the UI. So there's plenty of swaps there. Those tend to be smaller swaps, though. I think aggregators catch all of the solver volume. So these days people are using CalSwap or 1-inch solvers, these sorts of things, to do intent-based trading. And the solvers are connected to Maverick, and Maverick's at great pricing, so you tend to get a bunch of volume that way as well.
So this is, would you say that it's mostly because of the gas optimizations and the implementation of the internal, how the internal AMM works, is that you're able to provide better fees, so that as is a competition for these aggregators to get the best fees, they're coming to Maverick because of all these optimizations you've been working on?
It's mostly because the optimizations lead to a much more price concentration, and if you have price concentration, then the aggregators can get less slippage. So yeah, ultimately, if you go to an aggregator and they're going to fill more trades on Maverick than other dexes because there's better price concentration, which means less slippage for the trader.
Okay, that's by that metric, can we say that a metric of success for DEXs would be like kind of the market share that they have on aggregators, because these aggregators kind of are optimized already to get the best possible fees
Yeah,
compared to
I think trading through aggregators mostly makes sense. I think it's a user experience thing. If you but yeah.
okay. Perfect. Because users can be used to one interface, maybe whatever protocol it is, although that might not always provide the best fees. So that's very interesting. So now let's talk about the Maverick V2. So there are four main core features that are novel. Let's cover them one by one and see what does that mean, and what is the novelty here. The first one is lowest gas concentrated liquidity AMM. So V1 was already kind of optimized. Can you tell us more about what are the recent additions to V2 in terms of lowest gas fee, lowering even more these gas fees, and how is this achieved?
Yeah, I think just a whole bunch of solidity optimization essentially in the AMM. And so I think it's super important for the LPs, because if you want to collect fees, you have to get volume. And one way to get volume is to concentrate your liquidity. The other way is to make sure you have a very low fixed cost. So some like Curve has 250,000 gas trades, which is very, very high. So unless you have a giant swap, you're going to be paying so much gas that it won't make sense to route through Curve. UniV3 is actually okay. It's 150 to 170 depending on the tokens, and that's kind of the state of the art for concentrated liquidity. Maverick V2, you can actually get like 100K swaps, 100,000 gas swaps, which is very, very low for an arbitrary concentrated liquidity. UniV2 is still lower gas. It's maybe 80, but there you don't have any concentration. So there the slippage starts to overtake the gas overhead. So the hope is that by having much lower gas, you're going to get much more routing through these aggregators, which translates to fees for LPs.
And then also lower swap fees for traders, obviously, right? It's a win-win for
Yes,
everybody, kind of.
right,
Okay.
exactly. That's right.
Then the second feature is AI Dex via programmable pools. So there are two parts to that: AI Dex and then programmable pools. Can you walk us through what is this all about?
Sure. Well, one more feature in the AMM that's new, that's really cool before we go to the programmable pools, is that you can configure a pool. So when you start a pool, you configure the tokens involved and you configure the fees, which I think is pretty familiar to people. But in Maverick V2, you can also configure directional fees. So one of the kind of weird things about most DEXs, most AMMs, is again, you're agnostic to which token you hold. So in a USD ETH pool, you're trading the same fee whether you're buying or selling ETH, buying or selling dollars. But you may not be agnostic. You may actually want to charge a larger fee for selling ETH than buying ETH. You may want to buy ETH, and so you may have 1% fee one direction and a 1 basis point fee in the other direction. The fee in an AMM is actually the same thing as a spread to a market maker and sort of an order book. So that gap between the buy and sell price is what a traditional market maker has control over. And in every AMM to date, other than Mav V2, that spread is symmetric, which doesn't make sense. It's not how real market makers, TradFi market makers, set spreads. So in the Mav V2 DEX, the other flexibility you have is you can start a pool that has an asymmetric fee, and it lets you do things like it can express kind of a different sort of preference for how the assets you hold. It also lets you create pools and positions just to do kind of dollar cost average selling, which is really neat. You can set so the other thing about other AMMs is that you end up, say you do want to hold dollar or ETH and the price goes down and now you've got a whole bunch of ETH. As soon as the price goes back up, you're going to sell that ETH right back. But in a directional pool, you can actually create this friction so that you can set the fee so high, say 100% fee, so that you will never sell the ETH back. You're only buying ETH. And to combine that with the directionality, the movement modes and the distribution in Maverick, you can create some really interesting kind of buying and selling metrics just with the AMM. So you think about LPs using the AMM to collect fees, but here traders can essentially use the AMM to create really sophisticated buying and selling distributions. So that's an exciting thing as well. Then getting to programmable pools. So programmable pools, we think about providing the LPs with knobs that they can use to adjust how they move around the liquidity, how they position their liquidity, how they collect fees. And so programmable pools lets you create your own custom logic, either on swap or on add or remove, and or you can set fees kind of out of band of any of those things. you can change the fees of the pool. And so with those kinds of degrees of freedom, you can implement whatever strategy you want. And then so I can get into AI dexes, but maybe I'll pause there, see if all that's tracking so far.
Yeah. So something that I'm saying is that these are very interesting features. One idea that I had generally about LPing is that LPing is, I mean, at least initially, LPing was kind of a pretty passive thing to do, right? You just had some money and then you wanted some kind of passive income or yield or fee or whatever, and then you would LP on your favorite pools. It seems to me that with time, and especially with some of the features you're mentioning, this is becoming more and more sophisticated, and also it's becoming less passive and also more like expressing a view, right? So I can express a view on the direction of the assets that's on the pool. You mentioned about directional fees and all this kind of stuff. So can we say, I mean, this is a pretty elaborated product for probably more sophisticated LPs. Are you seeing this as an evolution from this passive mode where people just were providing liquidity? Can you elaborate on the kind of trend?
Sure. Yeah, I think so. Certainly in any of these, whatever you could do in UDV2, you could do in UDV3. There's a whole bunch of more knobs, but you could still do the old thing. Maverick is the same. So Maverick covers, if you want to have a XYK UDV2 sort of position, you can. If you want to have a stable swap position like Curve provides, you can. If you want to have a range AMM position like UDV3 provides, you can. So you can still do all of those things. I think where we're going is it's not as if the normal kind of retail LP will use all of these knobs and create their own programmable pools. The kind of evolution that's happening as people are building on top of Maverick is now the next version of Arrakis, for instance, doesn't have to implement keeper bots to move around price. All that's kind of there's a whole bunch of kind of developer UX sugar that's built in, so that if you want to go build a bot, a vault that does certain things with the liquidity, you can, and you can do it much easily and much more gas efficiently than you could in kind of previous iterations of AMMs.
So it seems that actually this is very powerful, because it seems that you have built in one product something that multiple different protocols had. For example, Curve stablecoin AMM. Curve AMM was optimized was optimized for stablecoins. Then we had Uniswap V2, Uniswap V3, and then Arrakis, and then Maverick V2 is actually integrating all of these elements, offering the exact same functionalities and actually allowing users to express whatever level of complication they would like to have using your product. So that's very powerful. So let's get back to the novel features of V2. We mentioned programmable pools, AI Dex. Can you elaborate a bit more on that part?
Sure. So there's this really fascinating trend or neat new tech in crypto, kind of AI, trustless AI, essentially. So ZKML, zero knowledge machine learning, and optimistic machine learning are big topics. And so Maverick V2, there's a few folks actually building AI-enabled programmable pools. And so what does that mean exactly? You can think about the logic in Maverick V1 of when to shift your liquidity is fairly simple. It's basically just a lagging price indicator. When the price moves left, I'm going to move my liquidity left. You can imagine much more sophisticated responses to outside stimulus, whether it's the price of a Maverick pool, the price of other DEXs pools for the same tokens, or the depth of other DEXs pools. When we say AI DEX, what we mean is having some sort of inference model that's more complicated than just move when the price moves. You can imagine some model that takes inputs from prices and depths from other DEXs and uses those inputs to understand how the liquidity should move and how fees should be set. It's not really tractable to put a model like that on an EVM chain. It'd be too gassy. The contract space that you get in EVM is only 24 kilobytes, so you would need a dozen contracts. It's just not very tractable. And that's where things like ZKML come in. So ZKML is a super neat idea that I can. So if we're not going to put it on the EVM directly, what's the other option? Another option is kind of like what Arrakis did, where you have some off-chain model that takes all those inputs, computes the output, and then you have a trusted mechanism essentially to set the fee on the pool, or set some new parameters in the pool. So this is exactly what Arrakis does. The problem with that is I'm trusting somebody to move the parameters appropriately, right? And if they lose their keys, then the parameters could be, somebody could do it maliciously. If they decide they're malicious, they could mess up the pool. Or if they're just lazy and they don't want to run the inference because that costs money to do that compute, and they just make up a number, all these things are kind of failure cases in this trusted scenario. So what the combination of programmable pools and ZKML brings, ZKML lets you run a model, run off-chain compute in a verifiable way. So say we create a pool and we all collectively agree that this pool will have to run the fees or whatever knobs that change in the pool will have to be set by this inference model that's off-chain. But we don't have to trust anybody to do it. We would love for people to be permissionlessly be able to run this model and update the parameters. And that's what ZKML lets you do. It lets you instrument the model with a ZK prover circuit. And not only do you get kind of the new fee out of the model, you also get a proof that can be succinctly verified on chain. And so the idea is you can have a programmable pool where somebody can run this off-chain model and then prove that they ran that model faithfully on chain and use that proof to update the pool. And so you don't have to have an owner of the pool that's the only person that can update these things. You can have anybody run that model off chain, whoever wants to spend the time and effort doing the compute to update the pool. And what that lets you do is have super sophisticated models where you don't have to trust somebody that they're actually implementing the model. You don't have to wait for them to kind of call the update call. Anybody can do that anytime permissionlessly. So I think there's a whole kind of revolution coming with this ZKML tech in a bunch of areas of crypto. And we're pretty excited that this sort of thing is going to show up on DEXs, and it's super early days. So we'll see how it evolves. But that's the AI Dex sort of thing that's going on.
That's very interesting. It's the first time I hear about this kind of machine learning functionality for optimization of pools. So to summarize, there is a machine learning model. We are using ZK technology to have verifiability, and then this inference is done. The proof of the inference is provided on chain, and the consequence of this model is that instead of having lagging models where this liquidity is follows the price movements, we can have forecasts of what price would go, and then the liquidity would kind of move beforehand, before even the price goes there, if it's forecast that there will be such moves. Is that correct?
That's one example. Yeah, so that's a great example. Or fees could be changing based on forecasts. So yeah, that's exactly right. Whatever smarts are in the model now, it also exists in this DEX. The DEX is extremely limited on chain because of size and gas constraints, but the model kind of opens up a whole new world.
But then who does the optimization of these models? Because I would guess, depending on the pools, the assets on the pools, the liquidity, the volume, the optimization of the model would differ. And this is something that, depending on the market conditions, parameters would the models would need to be retrained. And this is a kind of elaborated thing. You have to adapt constantly to have kind of a updated model. Who is taking care of that part, which is not on chain?
So there's a couple of ways to do it. In a programmable pool, you have kind of infinite flexibility. So you could make a programmable pool such that a hash of the model gets updated, and now so we step back a couple steps. Somebody's in charge of building this programmable pool. So that's probably not a Maverick function. I think Maverick will build a few of these programmable pools examples, but there's other folks in the community that are already building kind of these ZKML enabled pools. So I think whoever creates the pool has the choice of using whatever model paradigm they want. And you can choose to join that pool as an LP, or you don't have to join that pool. So the mechanics are somebody, maybe a protocol, maybe an individual, makes this pool. And they could even skim off fee as part of the programmable pool, for their service of making and maintaining this really neat model, where they don't have to. So you could make a model that you feel like you've trained it well enough that it's versatile for all market conditions. It doesn't need updating. Or you could have a model where you're having to update the model occasionally, and there's some sort of the programmable pool has some knowledge of sort of the model that's being used, so that everybody has to use the same model in that pool. But really, there's kind of infinite flexibility there.
That's very interesting. So traditionally in the AMM model, you had like three stakeholders. You had the LPs that were providing liquidity. You had the protocol who was like earning kind of part of the fees, and then you had the traders who were swapping. With this model that you're proposing, we have now kind of probably a new kind of stakeholders, which could be like machine learning engineers and data scientists who would be, for example, would kind of train these models and try to come up with models that work well for different market conditions and etc. How are they incentivized? Because if anybody can join their pool, then we should provide them some kind of incentives other than the fees, right? How does that work?
So there's no framework for it, right? So I think what we're seeing, so there's a few folks, a few protocols that are built on top of Maverick that are doing liquid locking, for instance. And so a protocol like that with their own token, they could bootstrap a whole token ecosystem with this sort of paradigm. And in the programmable pool, they can charge a fee to new LPs as they join, or through any mechanism they want. And so we really think about it. One of the Maverick taglines is a liquidity operating system. I think it's little core nuggets of technology. It's a picks and shovels sort of protocol that lets other protocols build on top of it and do really interesting things. So yeah, the short answer is it's not prescriptive. I think we'll see how the world evolves and who invents neat stuff on top of this.
Amazing. That sounds really interesting, and looking forward to see the evolution of this AI models on related to DEXs. So let's just wrap up with V2 features. So we mentioned, programmable pools and the fees, and these directional fees. Are there other stuff like there is this kind of flywheel, related to VE flywheels, etc. Do you want to kind of give us also a summary of these other features?
Yeah, I think the kind of the last two features are there's a novel VE model in Maverick, and so one of the things that's clear, so that there's this kind of token bootstrap thesis by Chris Dixon at A16Z, where he says this using Web3 to bootstrap new tech through token launches is really convenient. The token's liquid, you can give it to the community early, you can use that to get a whole bunch of eyeballs, and then if you've got a good app, you'll have stickiness past kind of after the token has been dispersed. So that is how it works. And once if you are a protocol and you're going through that sort of token flywheel, you need some way to have liquidity for your token so that it's got a swappable market, and so all these things work. And that's where DEXs come in. And so I think again, I got to give props to Curve for kind of recognizing this and creating the original VE models, where people who there it was utility for the Curve token so that you could vote with the Curve token to direct liquidity to these new pools, and kind of help these protocols bootstrap liquidity. So one of the elements in Mav V2 is that we've made it so any protocol can experience this VE flywheel. And what that means is that if you have a token, an XYZ token, you can mint a VE XYZ token in the kind of Mav ecosystem. And that VE token can be used for governance. It can be used to boost LPs in a given pool. It can be used to direct liquidity to pools. It can be used to incentivize other protocols to match your emissions. So what we kind of realized was this kind of VE model where you get sticky liquidity, you get really good governance, you get some kind of staying power with your users, you get the ability to do boosts for LPs and whatnot. That shouldn't just be restricted to the protocol token. So the Mav protocol token lets you do all those things with this new VE flywheel. But we've also kind of abstracted it away so that anybody can create a VE token and have those same effects in a pool. So if you think about Curve, you're only getting a boost if you have VE Curve. But with Mav V2, some other protocol, ABC protocol, can also create this boost with their VE ABC token, and they can create sticky liquidity where you have to relock you're incentivized to relock your emissions, these sorts of things. We talked about all the flexibility in the DEX. This kind of attacks the token bootstrap problem. And again, I think there's real opportunity to go help tokens bootstrap not just their liquidity and shape that, but also with governance and sticky liquidity and how they incentivize and all that stuff. That's what the flywheel kind of focuses on.
So is that the same that last year, around 1 year ago, we had this new method. Everybody was talking about this, new tokenomics flywheel, which was called VE333. And apparently Andre Cornge, who's working now at Phantom, popularized that. And it was coming initially from the Curve implementation, and it was a novel solution kind of, but it didn't really took off. Is this kind of in the same continuation, or is this an upgrade to the VE33 thing meta that people were talking about last year?
No, I think that was different. I think that was kind of misguided. So in Curve, the emissions are split between the LPs get half the fees, and the protocol/VE Curve holders get the other half of fees. And so you get this weird kind of bad set of incentives where people who have VE Curve, they want to LP super low risk pools. They actually don't care at all if the pool is providing liquidity or getting fee, because they're just counting on getting Curve emissions. And so the VE33, with Velo, so Velodrome uses this, and
Exactly.
solidly before them. They said, well, there's some messed up incentives here. Let's flip the script. And so in Velo, the LP actually gets 0 fees. The voters of the pool get the fees, the swap fees. So the voters are trying to incentivize where the swap fees would go. And then the LPs get Velo emissions based on who's voted for their pool. So you get this kind of funky setup. But now you get a kind of a different set of messed up incentives where LPs actually are just trying to get votes. They, again, don't really care about fees. They have no coupling to fees at all. They just want votes. And votes they're trying to couple fees and votes, but that's not a perfect coupling because you can also bribe these pools and you get some kind of wacky incentives. I think what we've realized in Maverick is you really can't just emit tokens to anybody, whether it's the LPs in Velo's case or and the fees go someplace else, or in Curve's case. I think, but what both of them have messed up is you're just emitting endlessly, even if there's no new money in. So in the Maverick model, emissions are only used as incentive matches. So the only way to get any MAV incentives is for some other protocol to bring MAV tokens to a pool and incentivize that pool. And so that them bringing those MAV tokens to the pool is new money in, like no doubt new money in. That's just on the incentive side. And what that lets you do, so that the problem with Velo and Curve is that you get, if you want to participate there at all, you got to play all these funky token games. And so being the liquidity operating system sort of narrative, we wanted to have what Uni has, which is like a core DEX where you don't have to play any of the token games if you don't want to. You're just providing liquidity and you've got like kind of the best of there. But then there are certainly certain huge use cases for incentives. And so we wanted to get that right too, but separate from providing the core DEX. Whereas in Curve and Velo, those are all really coupled together. So the kind of solution that is V2 is MAV emissions only happen for matching, where again, a new protocol wants to come out, they want to incentivize a pool, only if they bring new money in do they get a match. They can't just have a whole big treasury of VE MAV and just get matches forever, which is the case in these other protocols. So I think that's the big innovation. That's the big difference. It's actually super different. I don't think anybody's done it. We'll see how it plays out.
That's super interesting. So usually when you look at the tokenomics of any token, you have like kind of unlocks schedules. Like you can see, when they will, how much will be unlocked for which stakeholder. So here it seems that you have kind of a conditional thing where unless there is new money, there will be no schedule. So does that mean that there is no kind of unlocks or calendar or some kind of thing like that, or some kind of chart where we can see there is no such thing, right? It just depends on the inflows that we are seeing.
There's a max. So the protocol wouldn't just match the entire treasury on day one. So there is still a max schedule. But if you don't meet that max, it just gets pushed out in time.
Okay. So very novel features that I haven't seen anywhere else. So that's very interesting. So so is this?
But then, real quick, the key there is that you can replicate that with the push of a button in the UI to do that for any token. So you can imagine. So in this case, Maverick is having people come join and matching, but anybody can create a VE token and get the governance, and you can airdrop to VE tokens with the click of a button, pro rata VE. There's all these neat features that we found ourselves needing over the past couple of years that you just get for free. And then liquid lockers and vote bribing markets like Paladin are all integrated with this as well. So anybody who wants to be matching incentives can also use this model, which is pretty neat.
And then they would need to use MAV pools. They would need to set up everything on MAV, or they can have like their main like token pools on Uniswap, and then still use this kind of VE mechanisms that you have designed.
The latter. So the contract that does all this is called a matching contract, and you can provide matching incentives for really any token or pool. So yeah, it's flexible. It could be Maverick or other pools that they get involved here.
Let me ask you another question. I've seen that you have this term KYC pools. Are Maverick V2 pools permissionless like Uniswap? And what is this KYC thing? Can you elaborate on that?
Sure. Yeah, so they definitely are. So the vanilla Maverick pools are permissionless. KYC is something that you can do with programmable pools. So, again, programmable pools is kind of infinitely flexible. One of the very simple things you can do is just put a KYC gate on a pool. That's a very easy programmable mechanism to throw in there. And basically you just whitelist addresses. So in the kind of RWA real world asset world, there's some RWAs that can't just trade to non-KYC users. And so I think that's kind of stunting the growth of that ecosystem. But in Maverick, you can create a programmable pool that's got KYC that meets whatever standards you need for your RWA. And now you've got this, you've got all these fancy LP mechanisms for those holders.
So let's zoom out a bit about now with AMM models and Maverick V2. I've seen that one of the chains that Maverick is leading actually in terms of DEX is ZK Sync. You are now on a
Mm.
bunch of different chains: BNB, Ethereum mainnet, ZK Sync. Can you tell us about like how do you see, what's the strategy you're following? Like because there are now an increasing number of EVM chains, L2s, Blast, Mantle, older L2 chains like Arbitrum, etc. How do you see like the chain expansion strategy, and what do you think contributed to you being one of the leader indexes on zk sync? Was it just being very early, or is there anything else to it?
Yeah, so I think it was being early. That was the main thing. I think also, yeah, I think that's the main thing. So Maverick was actually doing the most transactions of any smart contract across any any chain for a few months there because zk sync was getting so much transaction volume. So that was pretty exciting. Um, as far as strategy, I think V2 was coming almost immediately after V1 came, so the V1 launch was fairly limited. I see kind of no reason that V2 doesn't just exist on all chains. There may be more clever strategies to bootstrapping and whatnot, but I think that's what we'll see is that V2 just gets deployed to kind of all chains, Blast, Scroll, Mantle, all these sorts of newer L2s where there is kind of a dire need for really flexible liquidity placing in these sorts of things. So that's the plan.
And then the objective is to move the liquidity, like to push LPs to move to L2, or will V2, or will V1 and V2 coexist together for some time?
They'll coexist. So all the smart contracts are immutable. So there's yeah, they can both coexist. I think people will tend to go to V2 because that's where all these token flywheels, Mavs, and then anybody who mints in the factory, that's where those will all exist. So I expect V2 to get V2's got low gas and it's got all these better features. So we'll see that happen. But the V1 contracts will be there forever.
Amazing. So V2 is going to be live soon. What do you have on the roadmap for the rest of 2024 after V2 is released?
So I think we're going to be exploring the programmable pools for a long time, I think. So at least 12, 18 months. With a new programmable pool, it's almost like you get a whole new AMM design out of it. And so the launch of V2 really doesn't have many of these programmable pools instantiated. There's some examples in our GitHub where you can, if you're a stablecoin, for instance, you can use the price to flip the directional fee based on whether you're above or below peg. So that's kind of neat. So some peg keeping examples for programmable pools out now, but that's about it. The ZKML stuff is not quite out yet. And so I think we'll see those sorts of things come out in the next 12, 18 months.
Amazing. Let's wrap up with some hot takes. How do you see? I would like to ask you, how do you see the evolution of the AMM like landscape, or let's say Dex landscape in the next few years? Uniswap is dominating by far, and they're one of the protocols that they had, and they were early movers. So of course this is contributing to their growth, but they are still innovating. We saw the pace at which they're releasing this V2, V3, V4, etc. And there hasn't been so far any DEX that has been close to them. So how do you see the market share moving around in the next years?
We'll have to see. I think it remains to be seen. I think with new chains and moving fast to new chains, I think that's really what will dictate how this world evolves. Do we keep having this huge proliferation of chains, and if so, I think there's huge green fields. Maybe if we stay in kind of a mainnet centric world, then Uni can kind of rest on top there for a long time. So we'll have to see how all that shakes out.
We are seeing that although we are seeing an increasing number of chains, and newer dexes are benefiting more from this launching very early on these newer chains, still a large portion of the TVL, or the entire liquidity is remaining on Ethereum mainnet. Do you think that it's really difficult to get any kind of market share on Ethereum mainnet now? With currently.
I think the gas is huge in mainnet. So I think Maverick V2's gas advantage, I think, will be a very big deal. I think especially as we move to this solver intent-based world, if you talk to solvers, they're super gas sensitive, right? That's how they're going to win and lose trades. And so they're always looking for gas optimizations on mainnet. So I think there is an opportunity to go there. Uni V4, interestingly, is going to be like a gas behemoth, right? They've gone the opposite direction. It's got more things going on. It's got to check for callbacks as you go through. They do get some simplifications with the new temporary storage stuff, but it's going to be much gassier. So I think there's an opportunity to snipe the Uni folks there. Yeah, so I guess we'll see how it plays out.
Amazing. Thanks a lot, Bob, for all these insights. That was a very interesting conversation about Maverick and AMMs.
Yeah, thanks for having me. I'll see you next time.